As a trader, you are probably familiar with several theories concerning market structure and cycles. Some of the more popular ones include the Elliott wave principle and the Dow theory. In today's video, I plan to add one more important type of market analysis to your trading arsenal, namely a price action-based approach, known as the Wyckoff trading method. The Wyckoff method consists of a series of principles and strategies which can be applied to all sorts of financial markets. I will break Wyckoff's method into 4 parts: the 3 laws of Wyckoff, the composite man, Wyckoff price cycle, and Wyckoff volume spread analysis. Wyckoff's method rests on 3 fundamental laws. The first one is the law of supply and demand. When demand is greater than supply, price rises, and when supply is greater than demand, price falls. The trader can study the balance between supply and demand by comparing price and volume bars over time, as a way to better visualize the relation between supply and demand. This often provides insights into the next market movements. Next, we have the law of cause and effect. The second law states that the differences between supply and demand are not random. Instead, they come after periods of preparation as a result of specific events. In Wyckoff's terms, a period of accumulation, which is the cause, eventually leads to an uptrend, which is the effect. In contrast, a period of distribution, the cause, eventually results in a downtrend, the effect. Also, we have the law of effort versus the result. The third Wyckoff law states that the changes in the asset price are a result of an effort, which is represented by the trading volume. If the price action is in harmony with the volume, there is a good chance the trend will continue. But if the volume and price diverge, the market trend is likely to stop or change direction. For instance, imagine that the market starts to consolidate with very high volume after a long bearish trend. The high volume indicates a big effort, but the sideways movement suggests a small result. So there is a lot of activity, but no more significant price drop. Such a situation could indicate that the downtrend may be over and the reversal is near. Wyckoff created the idea of the composite man as an imaginary identity of the market. He proposed that investors and traders should study the market as if a single entity was controlling it. It always acts in his own best interest to ensure he can buy low and sell high. Think of the composite man as an evil entity, like the bad guy in a movie, sitting behind the scenes, controlling markets by pushing buttons. His goal is to move the market to your disadvantage. The composite man is continually seeking to maximize his profits at your expense. The composite man's behavior is the opposite of retail traders, but according to Wyckoff, the composite man uses a somewhat predictable strategy from which traders can learn from. Here are some main ideas of the composite man. The composite man plans and executes his deception well in advance. The composite man is there to fool you to buying positions that he already accumulated. Composite man will tempt you to sell at the worst possible time, and he leaves subtle evidence of his strategy for those who understand him. Now let's use the composite man concept to illustrate the market cycle. The process of accumulation is the first stage of the Wyckoff price cycle. The composite man accumulates assets before most investors. The accumulation is done gradually to avoid the price from changing significantly. Bulls are gaining power slowly, and as a result, they are poised to push price higher. Although the accumulation stage is related with the bulls gaining authority, the price action on the chart is flat. In other words, the process of accumulation is illustrated by a ranging price structure on the chart. Higher lows within the range is usually considered a signal that the price action is currently in an accumulation phase. The markup is the second stage of the Wyckoff trading cycle. When the composite man is holding enough power and the selling force is depleted, he starts pushing the market up. The emerging trend attracts more investors, causing demand to increase. There may be multiple phases of accumulation during an uptrend. We may call them reaccumulation phases, where the bigger trend stops and consolidates for a while, before continuing its upward movement. As the market moves up, other traders are encouraged to buy. At this point, demand is higher than supply. The distribution process is the third stage of the Wyckoff price cycle. Here, the composite man starts distributing his holdings. He sells his profitable positions to those entering the market at a late stage. The distribution phase is marked by a sideways movement that absorbs demand until it gets exhausted. The price action on the chart at this stage is flat. One indication that the market is in a distribution stage will be the sustained failure of the price to create higher lows on the chart. The price action creates lower highs, which is an indication that the market is currently experiencing a sell-off. The markdown is the last stage of the Wyckoff price cycle. Soon after the distribution phase, the market starts reversing to the downside. After the composite man is done selling, he starts pushing the market down. The supply becomes much greater than demand, and the downtrend is established. When the bearish trend is finally over, a new accumulation phase begins. Volume is of great importance for the Wyckoff trader because it can provide valuable information about what's really going on behind the scenes. Wyckoff volume analysis provides confirmation of progressing events during the Wyckoff price cycle. As I said earlier, high volumes can lead to sustained price moves on the chart. Wyckoff volume spread analysis also helps you to identify periods when the price is transitioning between the different stages of the Wyckoff price cycle. When the price moves through a key level during the Wyckoff price cycle, you should consider the move valid if the trading volumes are relatively high during the breakout. If the volumes are decreasing, then you are probably looking at a spring, which is a false breakout rather than a real breakout. This is an example of an accumulation stage. Notice on the chart that the first two bottoms are slightly increasing. This hints that the market is likely in accumulation stage. Suddenly we see a bearish breakdown through the lower level of the range. However, the volume is decreasing during the breakout through the level, which suggests that this could be a false breakout, a spring, before the real breakout actually takes place. The price reverses after the breakdown, and at the same time the trading volume is increasing. This is a strong indication that the price cycle is likely entering the second stage, the markup. So how to apply Wyckoff method in your trading? Traders can use the Wyckoff price cycle to recognize upcoming price moves. For example, the end of an accumulation stage is the beginning of a markup, which could be traded to the long side. At the same time, the end of the distribution stage is the beginning of a markdown, which could be traded on the short side. Understanding the different stages within the price cycle will allow you to position for the next most likely price tendency. Ideally, you should enter a trade when the price action is transitioning from accumulation to markup and from distribution to markdown. First, you need to confirm the current stage when the price is ranging. It would help to identify increasing bottoms for an accumulation and decreasing tops for distribution. In addition, it would be useful to analyze the previous price moves for additional clues. Another way you could attempt to confirm an accumulation or distribution stage is by identifying a spring, which is the transitional price action behavior that often occurs between the cycle stages. Chart patterns can also be helpful in identifying accumulation and distribution processes on the chart. The potential price move out of a pattern could help you to identify the transition to a markup or a markdown. The actual trade comes when the price action breaks the range in the direction of the expected move. For example, you could buy when the price breaks the flat range through the upper level. Contrary, you could sell when the price action breaks the lower support level of the distribution area. And you must keep an eye on the volume to confirm that your decision is correct. If you are trading a markup, your stop loss should be located below the lowest point of the accumulation stage. If you are trading a markdown, then your stop loss order should be positioned above the highest point during the distribution stage. Here the cycle begins with the distribution phase. At this point, the price action breaks the upper level of the range. However, the trading volumes at that time are decreasing. Therefore, we can reason that a spring pattern on the chart may be forming. The price action reverses afterwards and breaks the lower level of the distribution channel when increasing volume. This was the ideal moment to enter a short position, placing a stop loss above the highest point of the distribution range. See that the markdown begins right after the sell-off and the price decreased aggressively. Then we see a sideways movement, which hints that the markdown phase is probably completed. If you haven't reached your profit target, you could close your trade when the price action begins to create increasing tops on the chart. When the price finishes a markdown stage, it starts an accumulation. During the accumulation, we see that the price drops on decreasing volumes and breaks the channel downwards. Here we see a breakout through the upper level of the accumulation channel. This is a strong buy signal, which you could use to go long. The stop loss goes below the lowest point of the accumulation phase. The price action enters a markup stage afterwards as the price rises, creating higher highs. After a strong increase, the price action starts to range, suggesting that the markup stage is probably completed and a new distribution stage is on its way. This video was basically an introduction to Wyckoff trading, and I try to keep things as simple as possible. If you enjoy this type of content and want more Wyckoff strategies, leave us a like to show support, and in future videos we'll go deeper with some advanced Wyckoff concepts that can be applied to day trading and swing trading. Until next time.